Today is lockdown day and I have nothing to do. Last year I started to know about the FIRE movement. I then started a few micro investing accounts such as Raiz Invest, Spaceship Voyager, Stake, and Superhero. I promised to give you an update on how they performed, and here they are. Number 1. Raiz Invest. My Raiz account had $0 until July this year. I was drafting my tax return and I realized the account never had any money in it. So I put in $10 and this week $90. So now I have $100 and I have all the green ticks on the app. This is very exciting because I really hate having less than 100% account strength. Now I am 100% and ready to roll. I hope that around 40 years from now, I will have over $1 million in my Raiz Invest portfolio. I choose the moderately aggressive portfolio because I already invest in 100% stocks allocation in my superannuation account. So it is nice to have a bit of exposure into bonds as well, so I can withdraw a portion of my investments in case of emergencies without having to lock in any extreme capital losses in my stock portfolio. Raiz charges me $3.50 per month, a bit more once my investment is over $15,000, and I don't really care how much they charge exactly. Paying a little bit of fees or even a lot of fees is acceptable if it helps me accumulate $1 million in 40 years. Plus, I just want to have green ticks on my screen and a congratulatory email from the CEO. My second portfolio I will run through today is Spaceship Voyager. My Spaceship portfolio is now worth a whopping $24.48, $10 from my own money, $10 from referrals, thank you guys, and $4.48 from investment income. Very happy with it. It was an awesome year for American technology stocks. Number 3. Stake. I invested $700 in late October last year into 4 different companies: Amazon American Express, the US Top 500 Companies Index ETF, Redfin Real Estate Agency, which I found from Midcaven, and until this day I still do not really know what they do. I never did any subsequent trades, but surprise surprise, today my portfolio is worth $906. That's a gain of around 30% in less than 12 months. I attribute this to a streak of luck and the current stock market bubble, which means a monkey can also achieve a 30% yearly investment return. There is one more stock I own, which is GoPro, which I got for free because I used a referral link to sign up. Don't forget to check out my referral codes in the video description for Stake and other platforms. Number 4. Superhero. Superhero has come a long way since last year. Now they have a mobile phone app and can also trade American stocks. Unfortunately, my portfolio has gone backwards. I purchased $1,000 worth of Beam Communications, a company which makes satellite phones, and now they are only worth around $800. In addition to these 4 micro investing apps which I signed up for last year, I want to give you an update of my portfolio outside of these micro investing platforms. Many financial influencers track their net worth monthly. I track my net worth typically yearly or when I am bored. Today is lockdown day, so I tracked my net worth and I am sharing it with you on the screen. The biggest store of value for me is real estate properties. Real estate tends to grow over and above inflation, and at the very least, they grow with inflation almost 99% of the time. Plus, they also allow me to leverage my investment, gain exposure to let's say $1 million worth of assets with only $150,000 to $250,000 worth of cash outlay. The second biggest investment for me is in business lending. I have a company which lends out money to businesses, Some of the loans are secured against a real estate property. This is typically called a private lender loan in Australia or a hard money loan in America. Not all of the loans I found are secured against real estate. Some may be secured against a motor vehicle, and some may not be secured against anything specific. Without setting up a company and funding the borrowers yourself, you can participate in something similar by investing through peer-to-peer lending platforms such as Plenty. That's plenty with an i.com.au. The rate of return is probably lower because they do personal loans instead of business loans. Personal loans are usually cheaper, but you do not need to worry about funding the customers, and you do not need to worry about performing the credit assessment. Before you invest into this kind of investment, please do read the PDS and perhaps even consult a financial advisor, because this is probably high risk. Depending on how you think about it, it may be more risky compared to investing in the stock market, and the gain is limited with Plenty. On the website, they are advertising an earnings rate of 6.5% per annum if you invest in the 5-year market, whereas if you invest in the stock market, you can get a 30% rate of return per annum if you are lucky. Now, the next allocation of my portfolio is in individual stock, superannuation, and managed fund. So my superannuation is basically in either individual stocks or index ETFs, and I put a lot of money inside superannuation because superannuation is a tax-friendly environment. This year, Australians can contribute up to $27,500 in concessional contributions, which are only taxed at a rate of 15%. This includes what the employer has already contributed. So if their salary is 100 grand, their employer would have contributed around $10,000, and they have around $17,500 extra to contribute. The dividends and investment income inside superannuation are also taxed at 15%. Pretty much everything inside my superannuation is equity investments, but I have a large portion of it in index ETFs, namely the Vanguard VAS index of the top 300 companies in the Australian Stock Exchange and the Beta Shares NDQ index of the top 100 technology and new economy companies in the United States. Around 14% of my net wealth is in the form of cash inside my offset account linked to my mortgage. Within the next year, I want to put this money to work either in another real estate property or in a managed fund. I like real estate because I can use leverage and the value does not go down very often, and I like a managed fund because a fund manager spends 8 hours a day every day analyzing various businesses to invest in, so a half-decent fund manager will almost certainly be better than me. I do believe that a good fund manager can beat a broad market index ETF, so I intend to put in more money into a managed fund rather than an ETF. This is the end of my portfolio update. I am just a little bit bored during lockdown. I don't think any of you watch all of it, but if you do, please show your support by hitting the like and subscribe buttons, and watch out for the progress of my Raiz portfolio next year. Let's see what other congratulatory messages I receive from the CEO over the course of the next 12 months.